My name is Michael Gaia, publisher of the Lead Lag Report. Joining me for the hour is Adam Johnson, who I know a lot of you have seen over the years doing the media runs, was one of Bloomberg's top anchors, and is currently the author of Bullseye Brief. Adam, for those who are not familiar with your background, just introduce yourself. Who are you? How'd you get involved in markets? How was it like transitioning from being an anchor to what you're doing now? And what is the biggest insight that you have?
Well, the biggest insight, I'll stay there, stay flexible, and always listening to the guy who's got the other side of the trade because he might or she might actually be right. Um, in terms of how I came to where I am, it's really kind of been a progression that started in college as an economics major, went to Merrill Lynch, structuring mortgage-backed securities, which is hard to believe because that was a long time ago, and they barely worked then, and I guess they, definitely didn't work in '08, and they barely work now. But then traded oil for a few years. Eventually went to a wonderful firm called Furman Cells in the '90s and traded stocks and stock options. Ultimately, we sold ourselves to ING. The CEO said, "Why don't we start a hedge fund?" We did. That was wonderful. We picked up the pieces coming out of 2000, the dot-com bubble, and had a wonderful run for about 8 years. At which point, I was going on Bloomberg and CNBC pretty regularly as a guest. And Bloomberg said, "Would you ever think of making TV a full-time thing?" So I did, which is, of course, how we met, Michael. And loved it, but really missed being on the street. So left Bloomberg and in 2015 launched bullseyebrief.com, which is really the sum of everything I just said that I did for so long. From analyzing companies to talking about companies and coming up with a stock pick every week. I'm a growth manager. American ingenuity is my thing. And so it's been a tough year for me, but that's all right because if I go back to 2016, I've still beaten the S&P significantly by a couple of multiples. So that's all right. I'm a long-term investor. I am not a trader, and I'm very comfortable with that. I find the less I trade and the more I read, the better off I am. But as we've learned from the past several years, or rather the past several months, and I guess year, um, you got to be a macro trader too. I guess everyone's kind of become a macro trader and a chartist, but I'm a stock picker, and I love talking to management. My secret weapon is going through the. I actually print out and I go through the transcripts of every time a member of the C-suite speaks, and I pull up my yellow highlighter and I just start highlighting stuff that jumps out at me, and then I run the numbers against what these people are saying, and that process has served me very well. So I guess that's a probably more than you bargained for, Michael. But there you have it.
By the way, that latter point is probably the exact. That's like the antithesis of, I think, typical FinTwit actually reading on the CEO side. I'm curious, what years were you trading oil?
Yeah, I traded oil at Louis Dreyfus Energy. I traded the jet fuel position from 1991 through, I believe it was 1994, possibly 95, and absolutely loved it. People don't realize that jet fuel trades at a spread to heating oil because jet fuel is just really high grade heating oil. Or said another way, it's really high grade diesel. And what drives the price of jet fuel is not jets flying around the world, because you know what that demand is on any given week or month. It's extremely predictable. What drives the price of jet fuel is that it's used as antifreeze in diesel in the winter. So if you have a really cold winter, you've got a bunch of trucks driving around the Midwest with a little bit of jet fuel in their 100-gallon tanks to just keep the diesel from freezing. So that's what drives the spread, which is sort of fascinating. I loved trading oil. It was a ton of fun. It's why, and I really do mean that. It's a fun thing to trade because it's so physical and you can appreciate it. You can walk up and down tanks. You put the dipstick in, you pull out a sample, you can evaluate the quality of it. It's just so real. And I remember 2 years ago when oil went negative. Do you remember, Michael, when oil went negative $35 that one day?
It's funny how nobody wanted to buy it then, but everybody wanted to buy it at the top, a couple of months
I
ago.
know. Well, the reason it went to negative $35 is because that was the price at which you could incentivize people, speculative traders, to go out, no joke. This is totally serious. No joke. Go out and rent rail cars fill them with oil at the delivery depot in Cushing, Oklahoma, and then have them transported to railroad sidings all over the Midwest, and then where you would pay rent for these full tanks of oil, rail cars to just sit there, and you sold futures against them as a hedge. So that's why it went to 35, and that's why it stopped at 35, because that's where the economics made sense. And I would never in a million years have understood that concept had I not traded oil. And so now, as I trade stocks, let's face it, some of which don't have earnings, being a growth guy, um, I think having that physical background gives me an appreciation for what it takes to go from being a speculative company to a cash flow generating company and ultimately a profitable company.
All right, let's take the audience through here, Adam. The experience with Bloomberg as an anchor, because I used to be on quite a bit as a guest. You would
Yeah.
often interview me, and one of the things which I think is interesting about the media more broadly is that ratings tend to correlate to the VIX, right? So there's
Right.
always
Right.
some hidden incentive, right, to create a degree of fear, and oftentimes it'll be nothing but bear pour and pretty much at the low. It's been joked about many times. CNBC's Markets in Turmoil is often a turning point, right, when it comes to markets. I'm just curious from your experience, Adam. Um, what is it about the way the media frames things that often makes people skeptical about whether a trend is going to continue? Is it simply just a matter of there's too much fear? Is there something else in the way that stories are covered? Talk through that, because I do think that we are at one of those potential inflection points in markets where all the doom and gloom was so loud that you can probably bet from a contrarian perspective that's going to go the other way.
Yeah. Well, first of all, I just want to address what you just said, which is quite an admission on your part that we might actually be at a bottom, because you have been much more bearish than I. You have been right. I have been wrong. So the
Well,
fact that,
in fairness, I've been right in the signal, but very wrong in the expression of it. Right? I've used that term
right.
hell. They all use treasuries. Treasuries have been worse than stocks.
Yeah, I hear
Even
you.
though the idea of being defensive was right, the expression of it, which is very weird, was very wrong. That might be turning, but anyway, sorry. Go ahead.
Sure. Yeah, yeah. But and yes, I do think that we are in the process, whether it's today, tomorrow, next week, 2 weeks from now, last week, whatever. We are in the process of forming an important low. I'm not going to call it a generational low because that's probably a little heavy handed, but I do think it's an important, very tradable, cyclical, tactical, whatever the right adjective is, low, where we are going to be able to make some money back. And certainly I have lost money in this, as have we all, but I think that is happening right now. As to your broader question about the media, I think our viewers would find it interesting to know that, our listeners, that much of the media machine, the producers, the executive producers, etc., um, are 20 somethings. They're very smart and they're kids. And forgive me if there are any 20 somethings listening. Okay, you're a mature kid if you're listening to this thing. But there are a lot of kids out there who have some very serious responsibility working at CNBC and Bloomberg and Fox Business, et cetera, Yahoo Finance. The way they distinguish themselves is to identify a guest who has a strong viewpoint and then to magnify that viewpoint. And a lot of times, the strongest viewpoint to magnify is the one that's most obvious. And so, in a falling market, the person who says, "Oh, yeah, you haven't seen anything yet. You think '08 was bad? Just you wait." And then they offer a couple of statistics to make that viewpoint come to life. And all of a sudden, the young 20 something producer says, "Oh, wow, this is so compelling." And, she's got great data and a strong viewpoint and she's telegenic. She looks good on air. Let's book her. And so they bring these people on and then they just start hammering it. And, they take a little clip, a little snippet of whatever that person said. Um, and the clip might be, if you think '09 was bad, wait till you see this year, right? And right, and then they'll string together 4 or 5 of those from different guests who come on over a day or two, and then all of a sudden that becomes the commercial or the pitch for you know, we keep you plugged in and we're not afraid to call it like it is. Boom, boom, boom. And they go from clip to clip to clip. And then they show you some chart. And then there'll be a video of a, floor trader on the New York Stock Exchange pulling out his hair. Never mind that there are only like 45 or 50 of them left. There used to be 4,000. But that's how the media game is played. And remember, the media only makes money if you pay attention. And you will only pay attention if you become scared and desperate and worried that if you don't pay attention, you'll miss something and lose even more money than you've already lost. So it becomes a hook kind of game. Let's hook them in here and let's scare the hell out of them. Because let's face it, it's a lot easier to hook someone if times are really bad and we're going to tell you something you don't know with all these people who've done the work and are asking the hard questions. That's so much more compelling than, oh, let's bring on Adam Johnson, Uber Bull. He's always bullish, right? It's like, really? I don't want to hear Uber Bull. Tell me something I don't know. Bears always sound smarter than bulls, so it's a lot easier to hype the bear case and to get people worked up. And admittedly, to the credit of the Bears, they have been right, and the optimists, like I, have been wrong. But I would also say that. I'm pretty sure Warren Buffett didn't sell on Friday when the PCE came out. A tenth worse than expected, right? I mean, we're trying to take a long-term view here and express themes and stocks that will make people not just money, but build wealth over time. That's my goal. And I would say that as bad as the past year has been, '08 was bad too, 2018 was bad, 2000 was bad, 93 was bad. I lived through all these. And if you look at a long-term chart of the S&P, we always come through. It's ugly and it may take a long time, but we do get through. And even I have to remind myself of that. Even I, the optimist, have to remind myself of that because I get down too, emotionally down, and especially when you hear the megaphone across media. So once again, Michael, I've probably spent too much time to answer your question, but
No. Actually, that point about the age bracket of producers is something that I had noticed for a long, long time. I was always amazed that it wasn't the anchors who booked the guests; it was a producer who was often somebody out of college that produced the guests. And
right.
you always right, and then you always question. It's like, okay, well, does this person actually understand markets, or are they simply trying to do their job, which is get somebody that is likely to get eyeballs, irrespective of whether the guest is making sense or not?
Oh, for sure. Um, your job as a producer is to get as many eyeballs as you possibly can, and whatever that takes. So if you're going to have Barstool Sports El Presidente Dave Portnoy come on and talk stonks and get in a heated argument, um, great. Wow, we're going to get so many eyeballs. Okay, yes, you might. Um, I remember when a producer brilliantly at CNBC got Carl Icahn to go on with Bill Ackman because they were might have been Herbalife, but I can't remember. There was some stock. One was long, one was short, and each absolutely hates the other guy. And they got into a shouting match on CNBC. And I got to admit, it was pretty good TV. It was very entertaining, but it was entertainment. I don't think anyone listened to that and said, "Oh, I'm going to go buy that stock or I'm going to go short that stock." It was very entertaining, and they got a ton of eyeballs. And then they posted out on social media, and that was great, and they could sell more ads against it. And at the end of the day, a media entity is simply there to sell advertising. That is all they do. They're not there to make you smarter. They might say that, but they're there to sell advertising.
Okay, now this point about being an optimist or pessimist, I always go back to this nuance that it's always a function of where you stop and start on a
Yeah.
chart, right? It's always about the endpoints, right? You can make
Yeah.
any argument depending upon whatever time frame you're looking at. You can be right being bearish now, but then the bulls will say, well, look at the last 10 years, right? 10 years from now, right? And things,
Right.
hopefully will be higher. So now let's talk about that from the standpoint of sentiment here. So I've been very loud and very aggressive in my tone, basically saying people need to, wake the fuck up, given the way that treasuries acted this year. And seemingly only now did I notice did people really start to pay attention to the carnage that
Yeah.
I've been seeing and feeling that I couldn't do anything about from a rules-based fund perspective when it comes to the bond market. And I get from making this point, Adam, that if this continues, this is like a system reset. You can't have capitalism function if the cost of capital is acting this volatile. Now, oddly enough, I find that to be the most bullish case out there,
Agreed.
right? The idea that the system actually does continue. Right. So I want you to talk through from your vantage point as somebody who tends to be more optimistic, broadly,
Yeah.
how you are viewing that negative narrative, how are you viewing sentiment here? Because you made that point, everybody has to be a macro trader, even though they
Yeah.
only are individual in their security selection. Talk
Right.
about that and sort of the potential for positive things to start happening.
Well, I would point people to the intervention by the Bank of Japan about a week and a half ago for the first time in 24 years. I mean, wow. You say, yes, so what? Why is a stock picker in New York talking about Bank of Japan intervention? Because that to me is a clarion signal. The deep pocketed people who matter are not only paying attention, but they're taking action. Now, you could also come back and say, well, yeah, okay, fine. The Bank of Japan was really upset that the yen has gone to 146 yen to the dollar. They like it at about 105. And so it's been a disaster for them. Well, yeah, that's true. They went out and defended the yen, and it paused and rallied, and then it's right back to 146 again. So did it really accomplish anything? No. But then we had um, effectively the Bank of England going out and supporting the gilt market last week. Data point number two, another central bank is defending itself. And you could say, yeah, well, that was short lived and they didn't really announce a true, quantitative easing. Well, guess what they had to do? Because the UK based pension funds were getting margin calls on the falling value of their assets, and they had pledged gilts against it. They were selling their gilts, which is like the UK version of treasuries. They were selling their gilts to raise capital against margin calls. So the Bank of England figured, well, how much are the margin calls? How much do we need to buy? And that's the amount they went out and bought. It was very targeted. And the fact that you would have the Bank of Japan and the Bank of England both within a week of one another taking action, I think, is why the US 10-year went from, I don't know, what was it, 408, 409, 410, whatever, to 369. That's pretty dramatic, because I think people were starting to connect the dots and saying, hang on a minute, is there a pivot or might there be change afoot? And I think those signals are extremely important for all the rest of us to pay attention to, because if we're going to make the argument that higher rates, well, if high inflation and therefore higher rates is what took stocks down, then potentially the opposite, lower inflation, and perhaps a less aggressive Fed, logically should, in theory, help bring stocks back up. And that's why I think the Bank of Japan and Bank of England interventions are so important. They may signal some sort of pivot by central banks in general.
Right, and I always go back to this point. It's not that the Fed owns the bond market; the market owns the Fed. Right, you can
Right.
apply that to any central bank because I shared in the nest. Why must every central banker now intervene? Because they'll be out of a job otherwise. The severity of the bond market collapse is different than a stock market collapse, right? Because all these economies are predicated on the quote unquote risk free rate, and if the risk free rate, whether it's the short end or the long end, is acting this volatile, right, and this fast,
Right.
you everything stops. I mean, that's,
Be-
I think, at the core. So
Agreed.
right.
Yeah.
So the argument, I think, would be here that if you cut off the systemic tail risk, with some kind of creative action by central banks to at least stabilize the bond market, that's enough of a reason for some kind of at least short term move higher. Now, I'm personally of the belief that you're probably in a multi year bear market only because housing is still very early in its own bear market. But of course, could be wrong on that thesis too. But how do you distinguish between short term bottoms versus kind of more longer term, to your point, generational lows? Because if you're a stock picker, you really want to buy those stocks that you love that are going to have a real future when everything is cratering in equities, not just bonds.
Yes, yes, that's right. And I've actually, to that point, had to shift the portfolio um, of about 40 stocks higher onto the quality curve, higher up the curve, I should say. I sold a bunch of, not a bunch, I sold some of my smaller, wonderful little growth companies that, quite frankly, nobody cares about at this point, and went into bigger, chunkier names with predictable cash flow that are well established, best in breed, run by great managements. Because I think that's, if you're a BlackRock or a Tiger Cub and you need to make some money back, those are the names that you can buy. Get a size position on, and they'll come back fastest. I'm talking about, names like Salesforce.com, Palo Alto Software, NVIDIA, Qualcomm. Um, sure, we can say the fangs just to make it interesting, um, uh, and and we can certainly broaden the argument out beyond technology as we should. To some of the industrials, some of the every single bank right now is trading at 10 times earnings and 1.1 times bank a book. Um, from Bank America to JP Morgan, on and on and on. Um, they're all trading in a pack. And a lot of these companies are quite solid, and cash flow, you can model out different scenarios, and what you'll find is it's not as dire as the predictors of total implosion would have us believe. And there comes a point at which stocks really do stop falling. They do find a bid. You take them down far enough. That's Tom DeMark, right? The DeMark indicators. If you have 13 days of selling, and they don't have to be consecutive days, he's got this very complex mathematical formula. You're basically counting days of exhaustion. And I don't know where we are on a DeMark indicator, but it's starting to feel pretty exhausted. So, what was the original question? I kind of got off on a
No,
tangent.
no, no, no. Hold on, but let's go with that because this point about exhaustion is important. I keep going back to it's more than just a question of depth of a decline. It's also the way that it plays out, the path. Right. I've showed that stat many times now. You look at the number of weeks that the S&P 500 has lost money
Right.
as a percentage of the year. You're nearly at 64%. 64% of the year using weekly data, the S&P has lost money. The only other time that's happened, is 1931, and you're almost close to eclipsing that. So you've been in this really prolonged path of weakness, right? Never
Yes.
mind the way the bond market's behaved. But also, yeah, as you know, right, talking about ingenuity and tech stocks, there's been weakness for far longer than just 2022. I've made that argument before that you can make a case that the real bear market started February of 2021 because that's when breadth started really weakening, and that's when breadth topped out. That's when you started seeing the ARC names collapse, and that's when a lot of things peaked, emerging markets as well. So you do have this length of time where you can just make an argument that we're due for some kind of a reversal because everyone is now almost conditioned to think that every
Yes.
week stocks will go lower.
Yes, and and it's so funny you talk about February of 2021. I was skiing with my godchildren up at Stowe, Vermont, that weekend, and I was so upset because I'd taken Friday off. I drove up Thursday night and took Friday off, and it was just an implosion. And I'm trying to be with my godkids and celebrate winter, and sweetheart, how are you? Tell me about school. And I had lost so much money on Monday. It was so hard. And yes, that is exactly when it all began. So we're it'll February will be here before you know it, and that'll be basically 2 years of hell for growth investors. And agreed, you can only have extended down markets for so long. Um, And you just go back historically, they only last so long. And then, I realize the question that you asked me, how do you distinguish between short term and long term? Yes, that is very true. And I will tell you that the worst thing anyone can do is what one of my old bosses used to do, which was to grade himself with every tick at every moment. So if we bought XYZ at $10 at 10:05, and by 10:34 it was 10:49, he'd be high-fiving me in the trading room. But if when he went to lunch, it was back to 10, he'd say, "Oh, boy, we should have sold it." And then if he comes back from lunch and it's 9:36, he goes, "Well, did you sell it? You stop yourself out?" We bought this for the growth portfolio that, has a holding period of 14 months. Well, but I mean, you didn't have to keep it, right? And but then a month later, if it, it's 12 or 15, well, it was hairy back then that day we bought it, but good hold, good hold. Yeah. Do you judge yourself at this minute or that moment or next week or the following? So what I always do, Michael, is when I decide that I want to own a company, and I do the write up, because every week I publish a new pick, about a 1,500 word report on a new idea, and I always say, here's the range at which I want to buy it. Here's the alert to the downside where I need to say, yeah, this isn't going according to plan. And here's the target at which I want to sell it. And I don't limit my target to 12 months like the Wall Street analysts. I'll as a growth investor, try to go out to 24, 25, model out the cash flows, put a multiple that I think makes sense, discount it back to the present, and that is my target. So, again, the question, how do you distinguish between short term and long term? By identifying where you want to own a particular asset and what you think it's ultimately worth, and then not worrying about the time frame. That's how I distinguish between short term and long term.
Speaking of the short terms, I was just looking this up as you were chatting. So if you look at the percentage of the Nasdaq that's trading above its 200-day moving average, right? What percentage of the Nasdaq is above in terms of the constituents above their respective 200-day? Well,
Yep.
right now you're at around 17.8%, right? It's above the 200-day moving average. Now, interestingly enough, the Nasdaq had made new lows last week, but in June, which was the prior low, right? That
Yeah.
initial rally off the June lows, the percentage of Nasdaq stocks trading above their respective 200-day moving averages back then was roughly 9.5.
Yeah.
So, from a technical perspective, I'd even argue that you've got some improvement. Yes, you have new absolute lows that were breached last week, but internally within the Nasdaq, it does seem like there is some kind of divergence, which you can argue might be somewhat of a bullish sign. I know that's not necessarily sort of the focus from a stock picking perspective, but more an observation about
Sure.
how everyone has gotten even more negative, I'd argue, in this drop than it was in June, but there's actually been improvement beneath the surface.
Yeah. Well, it's the classic double bottom retest. We hope. Um, and there are probably some people are saying, he hopes. Yeah, it's wait till you see what happens in 3 weeks. Okay, fine. Okay, Mr. Bear, whoever you are out there. Uh, uh, and that bear might be right. But the point is, you take stocks down far enough, and eventually people see value, especially on a retest. And um, you compare that and the action that you just mentioned, where the breadth is improving. In other words, fewer stocks are down as much as they were in June, even though the index is down more. Um, a momentum shift because you're bringing in buyers. Um, that's very important when you also consider that investor positioning based upon the Bank of America Merrill Lynch sentiment surveys is as negative as it has ever. And again, I say it is negative as it has ever been, coupled with some of the sentiment surveys like University of Michigan, et cetera, that about a month ago, I think it was also in June, were as negative as they had been in 50 years. Um, in other words, not only do consumers feel horrible, and we could also look, by the way, at the NFIB, National Federation of Independent Businesses. We could look at sentiment among small business owners, uh, almost as bad as well. So consumers, business owners, investors, all incredibly negative, washed out. I mean, it's hard to say about something, you've never seen it this low before. It's at a new low. But when you can say that about three indicators as important as consumer sentiment, um, small business optimism, and investor positioning, when they're all three at 50-year lows, ironically, with employment at 50-year highs and earnings at all-time highs, okay, fine, they may be coming down, but nonetheless, you start to say, hang on a minute, should we be buying some of these names? Maybe not all of them. We're not going to necessarily go by Qs and spies, but maybe some of these stocks have gone down too much, and we should be starting to buy thoughtfully. And I think your point gets to my point. You're seeing that in the data. People are starting to buy because there are now fewer stocks trading below their 200-day moving averages because people are starting to bid them up.
That's why I see Josh Young is on here. I've had him on a space, and I retweeted with a comment a retweet that he did of Zero Hedge showing how sentiment was basically at zero as far as people that were bullish.
Right,
And
right.
he, Josh had asked the question, kind of tongue in cheek, can sentiment go negative? And I responded saying, well, can oil go negative? Right?
Yeah,
It's like
yeah.
no, but I think this is really the point. It's like and I keep using that line: opportunity always exists when the crowd thinks it knows an unknowable future. Okay, that
Hmm.
goes along with anybody. It goes back to my point. Nobody can predict the future. Tell me about where the payout is highest. Now, could everything still fall apart? Yes. And the Bears unequivocally can still be right. And I've been bearish and going through all kinds of garbage this year with the way treasuries have interacted with stocks. But because of the severity of it, that's my point. It's like I keep using that line: the end of the world is the bull case.
Yeah.
You saw that in March of '09. You saw that in March of '03. You saw that in March of 2020. I don't know. Maybe we'll see it in March of 2023. Right. But it is just interesting to me how it's so one sided. And I'm sure, Adam, you've had some of this too, where, admittedly on Twitter, it is hard to find that many people that are bullish. Right. It's like I've been doing these spaces for nearly a year now. And the overwhelming sentiment has been bearish and has been right. Right. And I've been largely in my
Yeah.
own thinking aligned with that. But I'm sure you've seen this, as I myself have turned to a much more sudden 180 in my sentiment around the short term bottom melt up case, whatever. I've been getting insults. And I'm sure
Well,
as a bull, you've seen and gotten insults too throughout this,
oh,
right?
not only insults, but hate mail, where people are unabashed to or unashamed or whatever the right verbiage is to idiot. What's wrong with you? And the sarcasm is just par excellence. Fine, all right, I get that. But eventually, the optimists are right. They always are. If you're betting on the end of the world, that bet still has never paid off, right? I mean, it's never paid off. And if you thought that the end of the world was nigh in 2000, you were wrong. Okay, it took Nasdaq. It took a long time to for some of those names to come back. I will absolutely grant that, but it certainly wasn't the end of the world. And we were running the hedge fund, picking up the pieces in 2000. We did very well. Um, uh, you know, 2008, it was a disaster, but it did eventually turn and went on to be one of the greatest bull markets in history. 2018, if you remember, when everyone was so certain that recession was a fait accompli, the Dow dropped 20% from November to Christmas Eve. Christmas Eve was the bottom. We came in on the 26th and never looked back. The Dow was up 35% from Christmas Eve through early March. Um, Bottoms always feel horrible. I mean, right now feels horrible. My drawdown has been significant. Um, but, you know, March of 2020, we thought the world was going to end, right? Well, that was the fastest snapback rally the world has ever seen. I mean, put yourself in the mindset. I mean, imagine how people felt in Germany and Japan in 1945. Or imagine London in 1940 after the bombings there. Or imagine the Civil War. Imagine you were a farm setter in Georgia after the Civil War, and you thought, how will we ever rebuild uh, uh, the farm? It's too big. We can't take this on. I mean, think of the times in history when things. Think of Kent State when four kids were shot by the National Guard. You thought, how could the country ever heal? 1967, 1973, Nixon, water. How can we ever come back together? Right? There are always horrible, horrible times. And there are always people who are going to magnify those horrible times. And there are also going to be times when the people who magnify those horrible times are absolutely right and things can get worse. But eventually, and this is where my faith in it's my North Star of American ingenuity and my faith in humanity and creativity and our instinct to just survive and ultimately prosper. Uh, we figure it out and we come back, and it may take a while and it may be ugly, but we do, because the other alternative is unthinkable, which is failure and ceasing to exist. That is not an acceptable alternative. If you want to be negative for a period of time, you're absolutely entitled to be negative, and you may be right, but recognize that over the long term, asset prices do rise, stock markets do rise, people do get it right. Some businesses will fail, but the vast majority of businesses and people will get it right, and we will, one way or another, move forward.
Let me add three things before bringing in some of the audience. And by the way, everybody here, please make sure you follow Adam Johnson, whether you are bearish or bullish. He's kind enough to spend time with us, and it's good to get all kinds of different types of spaces, which I think is critical to get people out of their echo chambers. So 3 points. So one is, it's been my observation for a while, going back to even my marketwatch.com days when I was writing pieces there, that you're right when the counter argument is an insult. That's why I was asking that question, right? Because I'm seeing it myself, right? So that's
Sure.
one. Two, there's this other aspect of it from an intermarket perspective, which relates to the papers that I'm known for, which is that, yes, there are defensive sectors like utilities outperforming the broader stock market, weakness in lumber to gold. Yes, all that, it tends to be a leading indicator of higher volatility and major drawdowns for equities. But these areas have also now been doing that for a long time. Utilities have been outperforming pretty much the bulk of the year. Lumber to gold has been unrelentingly weak now for the bulk of the year. At some point, the leading indicators also get overbought in the case of utilities, oversold in the case of lumber, which would again suggest that maybe you have some kind of a reflex rally. And then the final thing I'll say before bringing the audience here is I shared it in the nest here. So my father wrote a book, Intermarket Analysis and Investing. This is one of the pages in the book that's on the nest at the top here. And this is from Charles Dow himself, father of the Dow Jones Industrial Average. When the market is down and dull, it's hard to make people believe that this is the prelude to a period of activity in advance. And I can see it. And I've been the loudest person talking about how this is so horrible at an environment, worse than 08, worse than 2020, given the way bonds have acted in the interaction against stocks.
Yep.
But at the same time, I also recognize that that extreme probably is going to be countered with some kind of other extreme, at least for now. Meaner version, he was first, shall be last, and last first, right, is always a
Agreed.
constant, right, in markets and in life.
Yes. Yes. There are so many extremes that we can point to right now, from sentiment to worst bond market since 1949. Um, uh, there was some stat about performance of I think it was the Dow that goes back to 1931 or 33. I don't know, some statistic in the journal today. I mean, no matter how you want to slice the data, you can make the case that things are at extremes, and they can always become more extreme. There's no question about that. But at some point, they do snap back, especially when you get enough extremes lined up. You just can't put all the weight on one side of a what do you call it, a teeter totter or a seesaw, and not expect something to snap. Well, I think that your observation about bank reserves is interesting, and I think it speaks to the contraction of the M2 money supply more broadly. Um, I would also note that credit quality at banks is still extremely strong. Consumer balance sheets, while not as strong as they are still strong, and employment at 3.7% is still near 50-year highs. So, bank balance sheets and consumer balance sheets are still quite robust historically. And I think that is probably the one of the most important reasons why we're not down more than we are right now. I think it also creates a backstop. Um, Remember, what's happening right now in markets is a result of a change in interest rate policy, which is a function of inflation. If you think that inflation will ultimately come down, then you can also make the argument that the interest rate policy will change. This is not the result of a balance sheet problem like 2008, which was at both the banks and at the consumers. Very different story now. So uh, that's why I think there's a backstop ultimately to what happens here. And what's the follow up?
But sorry, and let me just add one thing, just a thought to that. So, because I
Sure.
think it is interesting that the narrative, which makes sense, don't get me wrong, is that the end of free money means the bull market's over. Maybe the fact that the cost of money now has a cost again could actually be very bullish, because if you look at in terms of the concentration of where momentum took place, starting around end of 2012 QE3, this is very near and dear to my heart because it's the time I launched my when QE3 took place, zero interest rate policy was really getting entrenched. That's when you saw the FANG phenomenon. That's when all momentum was really being driven by just a select group of stocks,
Yes.
which could have been a result of zero interest rate policy. So, in other words, the fact that we are maybe, in quotes, normalizing to some kind of real cost of capital, you can actually make an argument that, well, if that zero interest rate policy was terrible for the vast majority of stocks relative to FANG, maybe now it'll be the opposite because there actually is a proper cost of capital.
Oh, for sure. They're being forced to make decisions about how to allocate capital. And arguably, when there's a cost to capital, those decisions are going to be scrutinized more carefully. They're ultimately more thoughtful. And you don't just throw around money. You say to yourself, "Oh, hang on, this is going to cost me 5 or 6%. Do we really want to do it?" As opposed to free. So yes, I think you're right that higher rates are ultimately productive. I mean, it's crazy to think right now that people are as upset as they are, although I can understand it, about mortgage rates with six handles. And I say that because my first mortgage was at about 7.5%. And I was tickled pink when I refinanced it down to 5 1/8. And I couldn't believe it when I financed it to 4 1/4. And then, of course, they went lower than that. Um, we got spoiled by artificially, absurdly low interest rates, and they're just coming back to where they belong. And there's a period of adjustment for that because, again, we got spoiled by 12 years of artificially low rates. But yeah, higher rates is ultimately, I think, constructive um, for the market. It's a tough medicine to take in the short term, but yeah, I think Michael, you're right. It's it's constructive. And Gordon, I said you had asked you said you had a follow up, so I'll I'm thrilled that you said 235. I thought you were going to say 220, which is like $55 a quarter. So if 235 probably is a little bit high. So if if you say 225, and let's just go to the old Bloomberg right now, and we just say where is it? 3650. How's that for a round number? 3650 divided by 220 is a 16 and a half, 16.5 multiple. If 235 is right, and I don't think it is, but and that's a bull talking. Okay, but if we say 235, that's 15 and a half. Um, and might that be too high? Um, yeah, it might, but I don't think CPI is going to stay elevated indefinitely. And in fact, we're already seeing the 5 year forward, the 5 year break even rates down. I know you say, yeah, well, that's 5 years from now. Okay, fine, but that's just the instrument that the market trades. Um, we've already seen commodities come down significantly. I mean, oil, wheat, lumber, take your pick, down anywhere from 30 to 40%. Um, we are seeing supply chains normalize significantly. There are only six ships waiting off the coast of the Port of Los Angeles right now to berth. If you go back a year ago, there were 40 to 50 on any given day. So dwell times at Union Pacific rail yards have dropped significantly. They're barely over 24 hours at this point. Freight rates, container rates have been cut in half from Shanghai to um, California. Um, So supply chains are normalizing. Commodities are coming down. Now we need to see some stability in wages and housing. Housing's probably the big bugaboo because that's 40% of CPI. But I will, and there's a weird thing, and now this is going to sound really inside baseball, but it's the truth. So that is raising rates initially can actually cause owner equivalent rents to increase by definition, right? Because rates are going up. So rents tend to go up. But what happens is because the cost of renting is higher. But what happens is in part because you're crowding out people from buying, right? But what happens over time is home prices go up, and people stop bidding, which means then home prices come down. And that takes longer to play out than the short term bump when you increase costs. So ultimately, and that's what I'm saying, initially, higher rates can stoke inflation by stoking owner equivalent rent. But as home prices start to correct longer term, they come down and that lowers owner equivalent rent. And since owner equivalent rent is 40% of CPI, that's what we really need to see start to come down. And we may still be another couple of months from that. But guess what? These things happen very quickly. I mean, it's already October 3rd. Holy cow! We were just on August vacation. So my point is, in the moment, it's very hard to say, Jesus, we got to get through 2 or 3 more CPI reports. Well, it'll happen. It'll happen very quickly, and the market will start to figure that out before it happens. So I don't think that we're going to see. Getting back to your question, CPI of 5.5% over an extended period of time. I think that there'll be downward pressure in part because M2 has come down so fast. And if you were to run a chart of M2 versus CPI over time, you would find that M2 leads CPI by about 3 months, and it's come down so significantly that the trajectory for CPI pretty clearly looks a lot lower. And you and I are not the only ones looking at that chart, by the way. That's that's starting to make its way. So so I do think there is some relief in sight on the CPI front. And as that happens, then you can start to play around with those different PE multiples that you mentioned, whether it's 220 in earnings or 235 in earnings. You at that point can start to say, well, hang on, maybe a 16 and a half multiple is okay. And by the way, if we get clarity 3 weeks from now that earnings are not as bad as we thought, then maybe 235 is okay for forward, right? And then people will start to game that out. We're not there yet, but I think that's going to start to be one of the exercises that'll happen over the next few weeks as we get into earnings. Yeah. Well, yes, I do find them very helpful, but not in my quote unquote trading strategy because I don't trade. I tend to buy and hold. Um, and something's really got to change for me to sell something before the stock hits my target. I always sell half when a position hits a target, but so I'm not trading. But yes, these divergences that you refer to certainly do wonders for my mindset, which is really important because I think the toughest thing about running other people's money or your own in a bear market is staying positive and not losing your sense of balance. These people are paying us for our expertise and perspective, and we have fiduciary responsibilities to them. And so we have to make sure that our minds are in a good place. And so when I see those divergencies, I may not necessarily trade on them, but they certainly help me feel better. And I think feeling better sometimes is an important victory unto itself. Yeah, space YOY. And by the way, the percent is just the percentage sign. It should autofill if you're on Bloomberg. Just type M2 and it'll show up. That's the year over year change. And I'll just for those of us who are not in front of a screen right now, I'll tell you that from 2016 to 2019, M2 was growing anywhere from 3 to 6%. In 2020, it spiked as high as about 26%. And since early 2021, it's been on a very steady decline, and now it's back down to 4.1. And if you were to chart that against CPI, which would take a little more time than I can do right now. You would see that M2 leads CPI by several months. So the fact that M2 has come down now to where it was practically at the lows of 2018, back when everyone thought we were going into recession, that bodes very well for CPI correcting lower, which means inflation is coming down, which means we're going to get the Fed off our backs, which means, in theory, we can start to think about growth stocks and rerun our discounted cash flow models with higher multiples to figure out what we can pay. I think you said it all very eloquently, and I would just be repetitive. So rather than repeat what you just said so well, I'll ask Michael if there are any additional questions.
Like I said, whether you agree or disagree, I keep going back to this point. It's like everything when it comes to markets is an opinion because nobody has a crystal ball, right? And it's I've used that line many times in the past. No amount of intelligence increases the clarity of one's crystal ball. But if everybody thinks they have a crystal ball, okay, it's time to maybe think a little bit differently, right? And again, I'm from the standpoint of somebody who was very vocal, being disturbed by this behavior in the bond market. It's very simple to me. It's binary. Bonds either stabilize and you have a melt up, or the entire system fucking collapses. I don't want to bet on the latter. Okay, even because I don't know how anybody wins in that. But let's go to AELB for a question, then Amar. Go ahead, AELB. Well, no, and that's my point, though, right? It's like I keep going back. I keep using that line. The end of the world is the bull case. I mean, that's exactly what you're describing.
Let me explain. Well, I don't want to say explain because that would suggest that I have facts, and I don't. But let me share with you three important interest rates that are real time right now coming off my Bloomberg terminal. Fed funds futures are pricing, as you just said, a peak in Fed funds at about 4.4% next March, several months from now. The 2-year is trading down 19 basis points today at 409, and the 10-year USGG, the 10-year is trading down, also interesting, 19 basis points at 364. So interesting, isn't it, that Fed fund futures are saying, yes, Mr. Powell does have the stomach to take rates up another percent from here. Fed funds is at 3.25 right now. So yes, he probably will take them to 4.25. Call it 250 basis point hikes, one in November, one in December, and then stop. Okay, is the rest of the bond market upset by that? No, because both the 10-year and the 2-year are down 19 basis points today, which arguably is probably why stocks are up as much as they are. Because this, if you recall a couple minutes ago, we were saying, well, hang on, if inflation really does come, if money supply really does come down, and that's basically what Mr. Powell is doing. If money supply really does come down, and it is, because now it's only growing at 4.1% versus 27% a year ago, then that will pull CPI down by definition. There's less money swirling around. So if there's less money swirling around, CPI comes down. Fed can do what it needs to do, but longer term money, 2-year and 10-year, is going to be cheaper. And isn't it interesting that we have the 2-year and the 10-year down 19 bips today? So I think that's all very rational and should take some of the angst out of worrying about Mr. Powell raising rates another 100 basis points by next year.
Yeah, and Adam, I want to hear your thoughts on that too, because it is a valid point, right? Stocks have competition in terms of yield. So again, I want to make it clear from my vantage point, I believe we're at an extreme in terms of sentiment, which from a short-term perspective, I think argues for the surprise move higher, right? At least the probability is favoring it. But that point about the yield competition, though, is important from a longer-term perspective, right? Because it probably should mean that instead of the whatever it was, 15% annualized returns that people got used to post 2012 in equities, that maybe that gets lowered because there is competition now with bonds, right? To maybe the historical 7%, whatever.
Yes, and Omar, I like the question.
I lost it. But anyway, my point is that what can end up happening with that competition of yield could be that the annualized return ends up being lower, right? Assuming that it's still a secular bull market. But Adam, go ahead. And real quick on the lumber, I agree on lumber. There's no question it's been unrelentingly weak. I keep going back to there's always a depth of there's a length of time also that the leading indicators lead for, right? And I would think that now actually lumber, which kind of makes sense, lumber probably should start to have some kind of a natural rebound just because if yields on the long end come back in, that at least delays, kind of immediate weakness in mortgage, right, with some kind of drop in yields from that. But Adam, go ahead.
So, Omar, your question about why not just buy the 2 year and sleep at night? Absolutely, everyone needs to sleep, and everyone probably needs a little income too. So, allocating a portion of capital to the 2 year is a perfectly acceptable, um, thoughtful, and maybe even correct strategy, I would imagine, for a number of our listeners. The larger question is, what's your risk tolerance? What money do you need now? What money are you willing to put away for 3 to 5 years? Um, and that informs the portfolio allocation decision, whereby you say, well, I'll put 10% of my money in the 2 years and 90% in stocks. Or maybe it's the other way. I'll put 90% of my money in the 2 year and only 10% in stocks. So again, yes, you're absolutely right. A 2 year that yields 4% is 4%, and that's income, and that's great. The question is, do you need that income? Do you need to sleep at night? Do you want to grow? And somewhere in there lies a balance that is unique to every person. An 80-year-old will have a very different response to that question than a 20-year-old.
All right, a few more, and then we'll let Adam go here. Adam's been a rock star on this marathon here with a very not very popular opinion, which I share, which is that again the conditions probably favor the exact opposite of what everyone believes with certainty.
Okay, first of all, I'm an optimist, so I generally don't short stocks. That's just not the way I'm wired. I will tell you that I think EOG is the best run E&P in the world, so don't short that. I think that Cheniere is blown out, but and will probably correct if the war in Ukraine finds some sort of off ramp. It's a very well run company. There are no shenanigans, but well, it's up a lot as the effectively sole exporter of LNG to the world. And I love that company. LNG is the ticker. Yeah, I wouldn't short either one of those. They're great companies, but if you're looking for where you might find shenanigans, inevitably working capital is where you start to see people kind of move stuff around. But you've got to be a forensic accountant to go through those income statements. So set aside some time. But if that's what you want to do, focus on working capital. And as far as percentage of growth stocks that are probably gone for good, um, it's I'm I'm pulling this. This is not. I hate to say this because it's not a quantitative analysis, but it's more sort of anecdotal. If I just think of companies that I've looked at or ones I've had to sell, it's probably 10 or 15% of the small cap growth indices where they'll just never come back. And I've owned a couple of them. I've had a few that just didn't work out. Got a couple actually. I still own, but yeah, 10 or 15% is my guess. Which it's hard. It's they're like children. You hate to see them fail. I love it. That's empowerment. That is wonderful. Yeah, the more people who get involved, and I don't, I'm not talking about just taking pot shots and day trading, but doing what you're talking about. Um, I love it. One of the reasons I launched Bullseye Brief um, in 2016 was education and empowerment, and I put my phone number on every email, um, and I love when people call me. Most people just email or text, but I love the interaction when someone has a question because um, that's someone who cares and wants to grow and learn and is thoughtful. And I do my best. I take it very seriously. I come out with a new stock pick every week, which is hard to do, but I do it. And I take these companies apart and try to explain it in plain English, explain what they do, what their special sauce is, why they fit my American ingenuity paradigm, and what I think it's worth and why. And I love that process, and I love the fact that there are other people who love that process. And so it's empowerment to answer your question, Jay. to you.
Yeah, no, and I'll add to that. It's like I was very loud last year ranting against uneducated speculation with all the rocket ship emojis and yeah, and Jay, I know we're going to do a space on this at some point. Sort of the distinction between those that are wanting to learn and put the time and effort versus the loud people who are maybe making more of it as a joke as opposed to a real serious endeavor. I think as this decline has eliminated some of that uneducated speculation, it's better overall for the community, right? Because you get more serious voices and more people that want to learn as opposed to just viewing it as investing as opposed to gambling. I think it's sort of the key thing.
Yes, and I also commented that I think we still probably have 2 to 3 months of um, unfortunately high CPI prints for exactly the reason that you just described. Owner equivalent rent hasn't adjusted yet. It will, but we're not there yet. As far as the services component, that's effectively a measure of people making more money, salaries going up, cost of living adjustments, et cetera. And my guess, and I say guess because I truly do mean guess, uh, is that will slow because it becomes self-fulfilling, right? If CPI is going down and you're a boss or you're an HR executive, you're not going to adjust salaries up as much as you would have if CPI were still going up. So, that's almost a self-fulfilling prophecy. It'll take time, but the bottom line is, yes, I think we still have 2 to 3 months of continued high inflation, unfortunately, but that eventually that does come down. And then the other question becomes, when do you think the market figures that out? I think the market is telling us it's already starting to figure that out. Again, if the 2 year and 10 year can both be down by 19 basis points today, I think the market's already starting to look forward. And for someone like me who's a growth investor, that's welcome news. I imagine for you too. Well, David, thank you for the question. I am an American-based investor, and my theme is American ingenuity. So I have
Okay.
I have 40 names in the portfolio that right there on bullseyebrief.com for the subscribers, um, uh, and I religiously adhere to my discipline. Which is just focusing on what's happening here in this country. So I would be misleading you if I tried to tell you what I think is going to happen abroad, or whether I have any expertise, whether it's Brazil or anywhere else. I will tell you, China for me is a no-go zone, because
Absolutely.
they keep moving the goalposts. So I certainly wouldn't touch China, as tempting as it is. Um, Europe is just so troubled by the fact that they've never taken the hard medicine, whereas our banks took write downs. European banks never did. They're all like Citigroup, like Citi, right? Good bank, bad bank, and the assets are still held on the balance sheet of the bad bank, which still is tucked into um, the big bank balance sheet. So Europe is just much harder. That's not to say there are not some exciting growth stories in Europe, but it's just much harder to get excited about. There's probably a fire sale happening with some of the UK based assets. And the fact that the pound has come back as strong as it has probably argues for some of the land companies, the REITs in the UK. And a lot of them pay very high dividends. But again, my thing's American ingenuity. I only write up, I only buy American companies for my subscribers. So I'm not comfortable saying any more than that. Thank
Yeah,
you.
no, thank you, everybody. It was a great conversation again. Everybody, please make sure you follow Adam Johnson. Check out Bullseye Brief. I know we went longer than we normally do here, but I thought this was really interesting, useful, and it's not an echo chamber for me. It's just it really is hard to find bulls on Fintoid, which is probably why a melt up is probably due. So thank you, Adam, for your time here. Thank everybody for joining. Thank you for everybody asking questions. Again, this will be an edited video on YouTube as well as on all your favorite podcast platforms. And enjoy the rest of your day. Thank you, Adam.
Thanks, Mike. Thanks, everybody. Bye.